Charles Schwab Futures. Mike Zaremski in Chicago. Morning, Mike.
Good morning, Lee. I think the theme for today is sector rotation. So we'll definitely talk about that today on our episode here.
Absolutely. Before we can get to the good stuff, though, a few logistical items. We want to hear from you. Send in your questions in the Q&A functionality underneath the presentation window. Keep our eye on them to make it as interactive as possible, but we can't always get to all questions due to the number of people on these sessions. We also have our usual written disclosures. Everything Mike and I talk about should be considered as educational and informational in nature only. Nothing should be construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts, but we do not recommend the use of technical analysis by any means as your sole method of investment research. We also look at ETFs and ETNs. If you're going to trade those products, read a prospectus. We're obviously going to look at futures contracts with Mike. Want to trade those? Let's go ahead and read the risk disclosure statement for futures and options. And with that, I'll put up the old heat map. A lot of news this morning, so let's get right to it. Mike, so after our shows yesterday, we did have the release of the Fed's Beige Book. None of the findings are really surprising. Basically, it highlighted that the economic activity declined in all districts, falling sharply in many, obviously due to the pandemic. Also, it showed the majority of districts showed sharp drops in manufacturing, and production was notably weak in auto, aerospace, and energy-related plants. However, the market does not care because that is basically in the past. Moving on today, let's start with geopolitical news. The market seems to sometimes worry and sometimes not worry about what is going on with U.S.-China relations. Seems to be shaking it off today, but Chinese parliament did pass that national security bill for Hong Kong. Because of this, the Trump administration is threatening to remove the special status designation for Hong Kong. If they in fact go ahead and do that, that would expose Hong Kong to the same tariffs that are on China. It also put the Chinese requirements for visas and other things that Hong Kong is not having to put up with at the moment. So it would be a little bit of a blow. Also, the House of Representatives approved legislation that the Senate had already approved, basically condemning China for its treatment of the Uyghur Muslims. That's going to the president's desk because I get the Senate had already passed that one. However, in spite of all that, Chinese Premier Li struck a conciliatory tone with the U.S., saying that the two sides should cooperate and respect each other's interests. He said, quote, "We have all along rejected a Cold War mentality. Decoupling between the two economies will do neither side any good and will also be harmful to the world." So trying to walk back maybe a little these tensions. Domestically, an executive order is set to be published today. I don't know if they've actually done it yet. That would reportedly open the door for federal officials to punish social media companies for the way they moderate content. The way that they are going to do this is they would allow regulators to rethink what is called Section 230 of the Communications Decency Act. The law largely exempts platforms online from legal liability for material their users post. So this is apparently in retribution for what Twitter did to the president with the fact-checking.
Fact-checking, right?
Yeah. So why might this be bad for these companies? Well, just if they pulled back on that Section 230, it would allow more lawsuits against some of these providers. So the market really doesn't seem to be too worried yet, though.
No, even though stocks are only down very modestly today. So
Yeah, Snap, Twitter, and all of those. Okay, we had a real data dump domestically today. Initial claims came out on Thursdays as usual. Actually decreased by 323,000, still though at 2.12 million, right around the consensus. Key takeaway, though, is that there was a big downturn in continuing claims. They dropped by almost 4 million to 21 million. So that is speaking into the market's narrative about reopening prospects. We had new orders for durable goods. They declined 17.2% month over month in April. That was right around the consensus. Key takeaway here is it wasn't much of a surprise, and the market is shaking it off. We also had the second estimate for Q1 GDP showed a downward revision to -5%. Again, it's backward looking. The market doesn't seem to care. All right. A couple other interesting things I saw today, Mike. The CEO of Bank America told CNBC this morning that he has seen bottoming patterns to the economy and said consumer spending has room to grow because they noticed that 30% of stimulus checks are still in the cluster of his accounts there. They haven't been spent yet. I thought that was pretty interesting. We also had a bit of a turnaround in the market when JP Morgan raised its target price on Apple, which gave the market a little bit of a boost. They raised it from 365 to 365 rather from 350. We also had pending home sales. They dropped a lot, more than the consensus. However, this is April data. Again, we're looking past that a little bit. The good news within the report, though, was sales of newly built homes in April, which are based on signed contracts, actually beat expectations significantly. Also, the chief economist, Mr. Yoon, who's the chief economist for the National Realty Association, had an upbeat look out. He thinks things are getting much better. And we also, you and I were just talking about this, we also had a better than expected report from home builder Toll Brothers. Right. With that, I'll shut up and turn it over to you, Michael.
Well, I think that's kind of the theme, though, about what we're seeing for any kind of economic recovery. And I think Lee was reading my mind, sir, because we're going to look at the crude oil market here to start. Actually, today was one of those anomalies there. We had the energy stocks data here on Thursday instead of Wednesday due to the Memorial Day holiday on Monday. It's always a one-day lag when there's a Monday holiday. And even though the numbers here initially were fairly bearish, we had a build of almost 8 million barrels of crude oil last week, which was, the consensus was for a decline, even though the API data showed another increase as well, close to that 8 million barrels. But the market here has actually reacted rather positively. It's actually up over $1 today here on the July crude, as the market here is once again trying to test that next resistance level around $35. You could kind of see here that's kind of where we had the last top was right around that $35 there back in April, and then we go back a little bit further just before that. Just after the chart gap there as well too, that $35 is kind of a line to sand so far. So that's your next upside target for crude. Above that, though, we got to look at where we had that little chart gap there back in March, and we look for when the gap finally was formed, and that high is 37.64. So that's your next target. Sure, we get above 35, and then of course filling in the gap, we have to get above, I think it's above 41, 41.88. So there's a couple resistance areas there, about $6 of upside resistance there that the market really has to get through to really keep this momentum on the upside going. On the downside, right now you got to stay $30 there. Looks to be your near-term support, and below that we break the trend line. We're probably looking, probably down to that $28 range. So it was good to see the market respond well to what seemed like on the surface a fairly bearish report. Though, if you look at the details of the report, there's a couple things that may be kind of corresponding to the rally in crude today. One was that gasoline inventories once again fell, and also we saw that the oil stocks in Cushing, Oklahoma, which is the delivery point for this WTI contract, actually fell by 3.3 million barrels. So once again, that storage issue that has been all the rage the last month here, it seems to be kind of curtailing, as there seems to be more storage opening up in the delivery point in Cushing. Ironically, though, seems like maybe some of the oil actually went to the Strategic Petroleum Reserve, as this is another week here. It was up over 2 million barrels for the week. So maybe you're seeing some of that, the U.S. government here maybe actually taking advantage of these lower oil prices and filling up to the top of that Strategic Petroleum Reserve. Let's look at a couple other markets here. We're talking about economic recovery here. Let's look at, here's the one I don't think we ever covered here, Lee. We're going to look at the hard rolled steel futures. The symbol is HRCN20.
What are they use?
Hard rolled steel. Yes. HRCN 20.
All right. So this isn't like iron ore futures like they have in
No,
Shanghai then. Okay.
no, this is rolled steel. So this is
Okay.
kind of like talking about maybe the auto industry, for instance, would use something like that, or any kind of thing that it's stamping and printing. If you look at this market, we've seen this market have quite a recovery there from the April lows, from about 450 per ton up to 540 per ton. And now we have maybe a little bit of a pullback here to the 20-day moving average. But overall, you got to say this market is pretty supportive. In fact, if you drew a trend line down from those lows there, you can see we're still well above the uptrend line from the April lows. So yeah, this is kind of it's almost kind of like a similar pan that we've seen in the crude oil market, and maybe even a little bit stronger. Actually, maybe later on we'll look at the SLX too to see how the steel stocks are
Yeah.
doing compared to the hard rolled as well. But I mean, you got to say this is a fairly supportive a market, even though. I mean, if we look back at 2018, and we were at over $900 a ton for steel, so we're well off the highs, but it's still a nice recovery. And it kind of, we kind of talk about the shape of the economic recoveries, whether it's a W or a V or a L or a U. Well, this is kind of like that other one they're talking about, the Nike swoosh. You know, you kind of get that swoosh there as well. And in fact, if you look at a lot of commodity markets, we're seeing this kind of swoosh pattern come in. So who knows? Maybe that'll be the ultimate way to describe the recovery. But right now, you got to look at those highs that were made there, just about that 550 zone as a next resistance. And of course, the 200-day moving average at 550 is your upside target. On the downside, 20-day moving average and the trend line are coming in about the same levels there, around that 516 area. So that's definitely an area to watch, because below that, we're talking about maybe down to 510 as your next support point. So kind of interesting to see how the rolled steel market is doing. We talked about Toll Brothers and the housing market. Let's look at lumber. Let's look at LBN 20. Maybe not quite a little swoosh, but also an upward market, though, with a lot of fits and starts here. It's interesting, though, we're approaching a test of the 200-day moving average just above the 380 level here, as we're starting to see the lumber market also make a recovery. So we're seeing a lot of these industrial commodities start to see a rebound. In fact, copper is another one you'll see kind of a similar pattern as well, too. So, you know, right now we're kind of filling in that chart gap, though, from March. If you notice there, we just got a little bit of ways to go. So if we could actually get above that 200-day moving average there, we could actually fill that chart gap here in the from lumber futures. Kind of similar situation here. We have support around the 20-day moving average, which is probably just above that uptrend line there around that 350 zone, and a move below that would probably go down to 340, maybe down to 330, though. Once again, this market is also looking at a little bit of a peak, and we'll look at the home builder ETF too to see how the lumber market is comparing to the home builder stocks. I think it was kind of interesting when we see the steel and the home builders, how it's a little bit of a difference compared to the kind of the underlying commodity there. And let's wrap it up here with the copper, HGN20. Because with all the issues going on with China here, I mean, really copper has held up fairly well. It's kind of a little choppy market like we've seen in lumber, only maybe not quite as volatile. Right now, we're still holding above that 240 level. That was kind of a key area we watched previously in the market. Even though we had little fits and starts, we are above 240. Right now, yes, significant resistance is probably not to almost 250, and then we have the 200-day moving average about 257 or so. So a lot of upside room there on the market. Downside, though, probably wouldn't want to see it go below 235 on a weekly basis. That's up a test there of the 230 zone. But once again, this could also be a little bit of that Nike swoosh pattern here as well in copper. So Lee, let's turn it back to you.
Yeah, we got a question on the euro.
Sure, let's look at ECM 20.
And any reason why it's kind of looks like it's breaking out a little bit of this range today?
We're seeing that on a lot of the currency markets, as the dollar is actually starting to move down towards its range-bound lows. We're seeing this in the Australian dollar, we're seeing it in the Canadian dollar, and honestly, I think all those things are actually kind of a positive for the world economy, because I think we want to see the kind of the dollar start to maybe weaken a little bit, because that strong dollar was definitely a sign of concern and fear in the economy, because that's kind of when we saw that spike low there in the euro there. We saw the dollar shoot up, and that's also when we saw kind of the depths of the equity markets as well too. So I think we're starting to see, countries starting to open up. We have not yet seen any big signs, knock on wood, yet of any kind of major spikes yet in cases. So I think we're just starting to see those green shoots as well too, and we're seeing that here in the euro. So, but what's that 200-day moving average as your next resistance level? And above that, though, if we can get above that, I mean, we're probably looking at, we can see 112 to maybe even a 112.5 on the upside. Should the market kind of pull back in the 200-day moving average, which given the move we've had here, we may see a little bit of resistance though. You want to see it stay above 110, which is your next support point.
Alrighty, let's go over here. Let's check rates today. Put up the 10-year yield. Still range bound. It's the best you can say.
Right.
Yields up a little though. I mean, that's good. Maybe they're selling some bonds, maybe to rotate a little bit into stocks. I don't know, but
you have to wonder if a lot of the funds there are underweighted in equities. So it'd be interesting to see as we get to the end of the month here, if we see a little bit of a more pickup in equities, kind of end the month there. So that'll be interesting to see tomorrow.
Yeah, very interesting. All right, let us look at the our bond signal. So it might be down a little bit. This is the principal, remember, of the long bond. So maybe we're going to get this cross. Maybe we'll get out of this trade. As I said, a lot of people take partial profits when you break that first moving average there. Be a pretty good trend following trade though, for sure. It's kind of just chopping around. If we zoom in here though, you could say that you just broke a little bit of support. Are we seeing that on the futures too? What's the symbol on the futures?
Yeah, it's pretty simple. So this is the TLT. Let's look at the USM 20.
Well, they haven't broken though. It looks like.
No, they got a little ways to go yet.
Yeah. All right. Let's move on to the market. On the chart. Okay. All right. Well, we continue. We want everybody's watching where we are versus the 200-day moving average. We are 2 days now above it. This is very good, and that would be your first support now on any pullback. We talked yesterday about the difference between in the S&P, how many are above the 200-day versus how many are above the 50-day. I've got some more data on that. So let's look at the numbers first as of last night. All right, so let's take a look at first stocks above the 200-day moving average, about 43, and then stocks above the 50-day moving average, 94. So that is a 50% spread. Okay. So if you are keeping track, that's the second highest spread in 30 years. The only time it was about here was in January 2009. What this means, let's go back to the S&P 500 chart. All right, so what this means is that you've got really good, you can just look at the chart and tell, but it means you've got really good medium-term momentum with a market that had been showing longer-term struggles, right? Because you've been not too much above the 200. So, of course, if, as I said, this is one of the highest readings, if we relax the parameters a little bit and just say, what happens if that spread is above 40, we have a few more data points. We've got 5 times this has happened, but since 1990, so this is 30 years. Suggest you might chop around a little bit in the next 2 weeks, but in every single time this happened, the market was higher 6 months later, 100% of the time.
100%.
100% of the time, yeah. All right, the other thing I want to show you about momentum, this is kind of interesting too. I got another chart here. All right, let me explain this one. So this is the 50-day moving average. This is 25% below, and this is 10% above. Okay, so we have had probably one of the most vigorous oversold to overbought readings in an awfully long time, right? We went from 25% below the 50-day moving average to more than 10% above. And if you take a look for the last 50 years, very interesting. We've got 1, 2, 3, 4, 5 signals. No, this is what we had to do on this one is that is such a big discrepancy that there really weren't any analogs. So we had to relax the parameters to going from 10% below the 50-day moving average to 10% above. And so this is even more extreme than that. And of the 1, 2, 3, 4, 5 times, the markets were higher 100% of the time, 1 month, 2 months, 3 months, 6 months, and a year later. So all that's saying is this type of momentum doesn't go away easily, I guess is my point. What's this? This is on the NASDAQ, but it's the same on the S&P. Yeah. All right, so I thought that was kind of interesting too. Let's look at some levels. So again, your first support would be the 200-day moving average. You got a little resistance kind of up here at somewhere just a little bit above
3130 it is. Yeah, 3130.
Yeah, 3130, right? That's what everybody's looking at there. Let's take a look. We have a question on the breadth. Yeah, so we haven't had a Zweig thrust. I'll show you that. We haven't had one. Again, we were very close in the beginning of April, but we just didn't quite get there because it's based on a moving average. So we don't have a Zweig thrust, but we can look at some of the other things that I thought was kind of interesting. Let's go to we're going to take a look at the SPW versus the SPX. And we're going to compare it to the SPX. So SPW, for those newbies, is the equal weighted S&P 500. And we're going to compare it to the market cap rated, the more commonly followed one. And, you know, after bottoming out kind of in the middle of May, it's been catching up. We kind of mentioned that you keep an eye on the RSP, which is the ETF that most people follow for that. So this is a kind of a positive sign. Now, some of it, I think, is due to the fact that we've had this rotation into value for the last few days, but I think that is getting unwound again. But we'll take a look at that in a second. Yeah, we can take a look at some of the advanced to decline lines. We usually don't look at the mid caps, but I think we should because they're beginning to move now. They're approaching the 200-day moving average, but what I've noticed is this breakout. And then you look at the advanced to decline line on those, a huge move. So you're getting some rotation into there, I would think. Let's take a look at the NASDAQ 100. I don't see any reason it won't go test the highs, do you?
Not at all, especially the way it turned around this morning where it opened weaker and then found buying interest once again. So like I said, get about 2 days on that rotation there to value from the momentum, and momentum's winning out again.
It certainly is. One thing, let's take a look at the growth to value chart. You'll see that rotation, but I think it's could be over. But where is it here? Yeah, so you can see the last couple days, this is the growth to value ratio. It dropped a little bit, but I think it's turning right around. If we go to our style, you can see what's going on here. Let's go to our style check. So you can see the today, huge, once again, outperformance, at least in the large caps of growth again. You see that pretty well. Over the last 5 days, also, you can see the rotation over the last week, right? The large cap growth had lagged, but now it looks like that may be over with. So is the SPW outperforming the SPX bullish for the market? It's not a negative. I'll put it that way. I mean, the more participation, the better. All right. Let us go. Oops. All right. Let us take a look at the small caps. Look at the Russell. Seems to me that both the mid caps and the small caps can make their way to the 200-day moving average anyway. And you can see we've had a little bit of outperformance of the small cap since the middle of May. All right, let's see what questions we have. Yes, can we give sentiment? Yes. What day is it, Mike?
Sentiment Thursday.
Yeah, I'll give you the sentiment letters. All right, so let's start with smart money, dumb money. We actually had dumb money cross smart money. Now, smart money's 56, dumb money is 64. When you've had that cross before, you had a little choppiness in the very short term. Okay. Okay, and then the newsletter writers, remember, this is as of Friday, though, so we didn't have the 2 big days in here. But the bulls were going higher to 50.5 from 49 the week before. If you get up much towards 55 to 60, then you start worrying a little bit. So it's not, I mean, it's still okay. It's not giving any real warning signs yet. Now, if we keep going, that might change a little bit. The bears slipped to 23.8 from 24.1 last week. It is the fewest since the first week of March. And then the bull bear difference is what most people look at, is it is expanded again to 26.7 from 24.9 last week. This is the widest spread since late February. But again, warning signs, you can get up to 30, 35, 40 there. So again, it's getting there, but it's not to a contrarian, you maybe want to book some profits yet. So it's a little bit more to go. And then we still have quite a not optimistic MONPA, the American Association of Individual Investors. Okay. They did increase. Now, this is as of last night. So this does take, into account the last couple days of rallies here. So the bulls went up 4% to 33, but that's still below their historical average of 38. A historical average for the bears is 30.5, and we're still well above that at 42.1. So they're not necessarily buying this, which is actually a positive. So we have basically neutral readings on 2 and a slight negative bias in the sense of being more bearish, which is actually a positive for the market. So you can't say that sentiment would derail this rally quite yet. All right, we have some questions. How could there be a Russell large cap? You thought the Russell was small caps? No, the Russell indices, there's the Russell 1000, which there's 3,000 stocks in the Russell Industries. So the overall, which is 99% of the capitalization, is called the Russell 3000. The Russell 1000 is the 1,000 biggest cap stocks, and then what you're talking about is the Russell 2000, which is the small caps. So that's how that works. Okay. All right. Is there a way to find mid-cap health stocks? Sure, you could just go to the screener and just say you want, maybe under 4 billion in market cap and in the healthcare industry. You could do that. All right. Current PE ratios, they are elevated. It's more than 20 times 2021 earnings. The market is actually thinking that we're going to have the same earnings in 2021 that we did in 2019. So it is a little bit, it's
a little optimistic,
frothy.
yeah.
A little optimistic. Yeah. Okay. All right. Let us look at sector action. So let's just see what's going on today. So the utilities are getting a bid. This is the first time in a while they've gone to the top. Let's take a look at them. Let's take a look at the XLU. No, it's a good way to check if you see something that's at the top of the list that hasn't been there in a while. It makes you just look at the chart. Still nothing major, but I suppose you could say you broke. Whoops. Suppose you could say you broke this downtrend line. But that said, it looks like you did. There was a little resistance in here that we did break out of, maybe suggesting a test of those previous highs of the last trading range. So, and you can see the relative strength here is picked up just a little on that. Let's see what else is on the list. Healthcare equipment and services, coal, aerospace and defense, and I don't see. Let's see what the home builders are doing. We had a couple of questions on that. We wanted to take a look on that. So, I mean, they've been on a tear. We've told you about them.
Right. Yeah,
I mean, there's nothing wrong with that chart.
Nope, not at all. In fact, it's like I said, we're kind of definitely outperforming the lumber market as well too. It's definitely a stronger chart as well. So
yeah, I mean, you might have another pullback. I mean, if we close that would be called a dark cloud covered candlestick, which just suggests maybe another day of weakness. Maybe we test the 200 again. But I mean, that's an uptrend by definition. Right. Let's look. Go back to our list and let's look at the banks, because they had moved the last couple days in that little bit of rotation, but let's see what they're doing now.
Yeah, earlier they're definitely pulling back today.
Yeah. You might also, I don't know. I don't want to take out yesterday's low. That wouldn't be good. Um, again, if we keep rotating out of these again, this would be a bearish engulfing candle right at resistance, which would not bode well. But we haven't done it yet. But we're certainly giving back a little of this rotation that we've had the last couple of days. Let's take a look at the regional banks. Same thing.
Same thing.
But the bull in me would say we haven't, all we're doing right now is testing the breakout level. So we have to see how it behaves around here, whether this rotation can regain its legs or not.
And it's probably the banks there that are kind of holding back the Russell today too. So
Yeah, I think so. All right, let's take a look at energy. It's trying to break out again too. It's trying to fill that gap.
right.
These guys have not broken out, but they've been doing okay. These
Right.
are the exploration companies as opposed to the majors, right?
Right, but they were definitely the lagger of the group for sure. So they still got a little ways to go, but it's like I said, little positives though. I mean, if we do start to see economic growth start to come up there, when with all the production spending that's been cut and the amount of production in general that's been cut here as well too, you could actually start to see supplies start to tighten as well if we can keep this momentum going.
Yeah, for sure. You want to look at retailers? All right. So there's a couple ways we can do this. You can look at yeah, Amazon's got a pretty good rating. Let's look at the XLY. And then let's look at discretionary without Amazon. Still
Yeah, that's
improving.
still improving. Yeah, but definitely definitely lagging. Yeah, Amazon's
Yeah,
the whale in that sector.
yep. Let's take a look at Amazon. So we're kind of range bound up here. So you'd have to say that was kind of a successful test of the 20-day moving average. And we dropped below it and they bought it right back up and closed it above it. Looks kind of just like a regular momentum pullback. Maybe looks like we might go
Yeah,
test the high again there for sure, which would help the XLY. All right. Let's just look at a couple other things here. We're going to delve within some of these industries too. So we're going to go. So software is going nuts, as are the oil service stocks. So let's take a look at them. Mm. Put this one on a watch list for a breakout, right? Put it in a word.
right.
Also, if you were, if you want to manage a position with this, you can see the 20-day moving average is key on this one.
Yeah, yesterday's test of that it broke just below that, and that was found on the buyers below there.
Yeah, very strong looking chart. Okay, let's look at another area is cloud computing. Let's take a look at that. So same thing.
Same thing.
So that whole group is looks like it's poised to break out again.
Does Salesforce have earnings today or tomorrow? Is it today?
I don't know. Anybody know? Well, let's figure it out. Show everybody how to figure that out. Yeah, so what we did was we right-clicked in the chart just to go over with the symbol to schwab.com, and they're going to report after the close today,
Looks like-
Mike. Looks like.
There you go. So yeah, definitely something to watch there.
Yeah, I mean, yep. All right, let's see what else is freshening up today. So we didn't talk about silver. It looks like the silver miners are moving a little bit. Let's take a look at them. Ooh, nice momentum
Nice
back
test
to the
there.
20.
Yep. Yeah, and we're still seeing the gold silver ratio stay below 100 again. So still elevated, but we're keeping below those extreme levels.
Yeah, so this is a classic swing trading setup, a pullback to the 20 to buy it when it takes out the previous day's high of the day of the pullback. First target is the old high, and you get a little out of there, and then you just keep watching the 20-day moving average. This one's kind of classic. All right, you get a lot of interesting ideas just looking to see what's moving. It makes you look at the charts, as I said. Let's see what else we got here. Medical devices, huh? Or these are providers. Take a look.
Yep.
Yeah, watch this one for a breakout. Again, we're not recommending ETFs. It's just a way to, it's an easy way to keep track of industries sometimes. And let's take a look at, see if the biotechs, which had taken a breather, what's going on with them? Wow.
Yeah.
They bounced off support. So watch this as a kind of a high flag in here. That might break out. Take a look at the XBI. Then we also were talking about the gambling stocks. They're going to reopen June.
Was Vegas, right? Coming.
Yeah, June 4th, is it? I think. Yeah, we've told you about this breakout. So looks to me like that could grind its way up to the 200-day moving average. These are the gaming stocks. See what else is moving. Hot stocks are moving again. They got really beaten up badly, but there's a breakout for you.
For the breakout, right?
Again, the
So
mid
besides,
move.
yeah. What besides banks? What's lagging today?
Let's go the other way.
It's that contrarian in me. You got to look at what's.
The airlines are taking it. The banks, you can see that. Travel. So we had that little rotation into those beat up ones, but now they're looking
Right.
at giving back. We saw the home builders were retracing just a little bit. Take a look at the gold miners. We didn't look at gold today, but
Gold was a little bit higher on the day. Miners are.
yeah, I would on this one. I mean, we've made. I think here to get back into them, if you're not, you got to go back above the 20-day moving average. Right now, it's acting as resistance. We ran up there today and stopped.
Mm-hmm. Plus, even the gold chart there, you got that kind of double top there that hasn't been able to break through yet.
So let's take a quick look. Yeah, there's the double top.
Yep.
Move that. Went from a triangle to a double top. There you go. Yeah, so it's range bound now on gold, so the miners are taking a little bit of a breather. And with that, thank you very much.
Thank you, Lee. Always goes by so fast.
It does. Coming up next, we have information on Schwab equities ratings with our buddy out there in Chicago, Adam Lynch.